Just because the bull is aging doesn't mean it's dying. What history tells us about the fourth year of a bull market in this week's fastest 4 minutes in finance. Hello, I'm Scott Inman. Well, the beginning of the current bull market was October of 2022. The S&P 500 index has surged 80% since then. The index has posted double-digit gains for 3 straight years. And as we've pointed out in previous videos, it's extremely rare to have those kinds of returns for 4 straight years. However, it is pretty common for the fourth year of a bull market to be strong. Take a look at this chart from LPL Research. This shows all of the bull markets that lasted at least 4 years going back to 1949. And you can see 7 of those 8 were positive in the fourth year. The average gain in the fourth year is 12.8%. In fact, on average, the fourth year of a bull market is stronger than the third year. But that brings us back to the current bull market. It's unlikely we would have a strong fourth year that was bigger than the nearly 18% return we enjoyed in 2025. But the fourth year of the current bull market is already up about 5% since October, and LPL Research believes policy tailwinds and the continued momentum behind AI build-out will keep the bull charging. One of those policy tailwinds is the expectation that the Federal Reserve will continue to cut interest rates in 2026. History tells us that could be a huge catalyst for the stock market, although it greatly depends on why the Fed cuts. So generally, the Fed would cut interest rates when growth is slowing. The theory would be if there is the threat of a recession, lower interest rates might help spur borrowing, which could increase spending. But the Fed sometimes cuts in an effort to return data to the norm. Like in this recent cycle, the Fed began raising rates 5 years ago to cool inflation, and it largely worked. So as inflation cooled, the Fed began backing off interest rates. Which way the stock market goes in 2026 depends greatly on whether we enter a recession or not. This chart shows it. When the Fed cuts rates at or near record highs in the market, the stock returns over the next year average 13%. If there is no recession, that return increases to 18.2%. If we do have a recession, it's negative at 2.7. So only time will tell. But the key takeaway is that the bull market doesn't die of old age. It'll take a negative event or environment to stop our run.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.